and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I will give an update to my portfolio, and afterwards I will look closer at the subject, covered call options, and whether or not it will actually be a good idea to use such a strategy to increase the cash flow from your portfolio. So if we start with the portfolio update, the first thing you immediately notice is that there's a green circle for this week's episode, meaning that the portfolio is up in value compared to last week. If you then look at the pie chart over here, you can see that I have increased my stake in the healthcare sector. And just to get it even more clear, if we look into the history tab, then you can see that I have sold out of tanker factory outlet centers. So I bought them at January 2020 and now I have sold them with a gain of a little more than 20%. And if we go back to the overview arc here and scroll to the top, then the healthcare stock that I have been adding into the portfolio is Merck, since I have added an additional 100 shares. So if we go to the portfolio values tab here, you can clearly see that the cost has increased and that the value of the portfolio has increased as well. And since I have both been buying and selling stocks this week, then it is perhaps a little more cumbersome to see how much the actual gain has been within this week. So if we take the value of the portfolio last week minus the cost, and then we do the same for this week, so you say the portfolio value for this week minus the cost, and then you take the total for this week and minus the total from last week, then you can see that the gain of the portfolio for this week has been very close to $1,600. So obviously I'm quite pleased with the result for this week. And if we go to my dividends tab, it becomes much better, because for the first time ever I have breached the $500 mark in dividends within a single month, since Nexstar Media Group paid a little less than $30 on Monday. And I mean, more than $500 within a single month. This is actually serious money. I expect to be able to live around $2,500 a month. So I mean, at least in this month or in May, the portfolio could handle 20% of that without me having to lift a finger. That really motivates me to just keep adding money into the portfolio to increase the passive income. And as you can see here for June, we are already on good track, since I have received a little more than $20, and they came from LTC and Wells Fargo. So obviously you can see here that the dividends vary a lot from month to month, but you can actually see that the trend is upwards. And if it's more clear, if you just want to look at the quarterly dividends, then you can see at least since Q3 of 2020 that they have been steadily increasing. And I would expect that my quarterly dividends for Q2 in 2021 will actually be higher than the $826 that I saw last month. For instance, since I have now added an additional 100 shares of Merck, I have increased the quarterly dividends by $65. Then I of course have to subtract the $10 or a little less than $10 that tanker factory outlet centers paid out once a quarter. But that still means with my latest purchase that I have added $55 in extra quarterly dividends. It is obviously also very encouraging to me when I now look at the estimated yearly income and see that I'm closing in on $4,500 a year. I mean, last year I received a little more than $2,000, and this year I will probably receive more than $4,000, meaning that I will be doubling my passive income since last year. That is really motivating for me. I know that I have also put in much more capital into the portfolio than what I expected in the beginning of the year. This is due to the fact that I'm being hit by negative interest rates, so I have lowered my cash buffer, meaning that I have simply supplied more. And then at the same time, there were these things about paying out some holiday funds instead of having the government to invest them for you. And then I had some overdue hours and stuff. So I have received much more capital than what I would have expected than the year began. And since I am still not able to travel too much, I am simply just investing everything that I can. So since we are now 5 months into the year, let me just go and take a quick look and see how much cash I have actually added within this year. An easy way to figure that number out is to take the cost of the portfolio for this week and then the cost in week 1. Then you can see that I have added an additional $43,000 into the portfolio. I was actually quite surprised when I saw this number. This is much higher than what I would have expected when the year started, since I want to add at least $1,000 every single month. But due to the fact that I have received much more cash than I expected, and at the same time been able to lower my cost, and then also being hit by negative interest rates, meaning that I have lowered my cash position, that is why I have been able to add so much cash into the portfolio. But I was still quite surprised to see the number because it's much higher than what I would have expected. If we go back to the overview arc, I actually have one more news item that I need to share regarding Merck, since they have done a spin-off within this week. So if you go to this article from Business Wire, I will of course include a link in the description below. Then you can see that you were supposed to receive 1/10 of a share in this newly formed company called Organon for every single share you had in Merck as of business day May 17th. So at that particular point in time, I had 100 shares of Merck, meaning that I was expecting to receive 10 shares in this newly formed company. But currently I have not received anything on my broker, so naturally I have sent them a question and asked when I can expect to receive anything regarding this newly formed company. Now let's turn to the topic of covered call options, and in particularly the strategy around it. So in the dividend investing community, naturally a lot of investors are focused on income. It sort of is ingrained in the strategy that you're focusing on how much passive income you get every single month, as you can see from my channel, for instance. So there are a lot of people who are trying to focus on how to maximize the income they get, and they can do so by initiating a strategy where they are selling options on stocks that they hold in their portfolio. So let me first explain what a call option is, and then what a covered call option is. So let me start completely from scratch by explaining the simplest concept, a call option. An option is the optionality to do something. A call option is the right to buy something. So if you have a long call option, long simply just means that you have purchased it. So in this case, if you look at the blue line first, here you see a long call option. It has cost $5 to buy it. The $5 is also referred to as the premium. Then you can see here, if the stock price goes to 50, then the value of the option starts to increase. That means the strike price is $50 for this particular option. That means you have paid $5 today to be able to buy the stock at a predetermined time into the future, for which you will pay $50. So if the stock, for instance, increased to a price of 60, that means that your option is now worth 5 to you, since you have paid 5, but you can now buy the stock for 50. So 60 minus the 5 gives you $5 into your pocket. And as you can see here on the screen, the more the stock price increase, the more the value of the optionality increases. And you can see there's technically no limit to how much the stock price can increase, meaning that the option value can also increase infinitely. This is a really important concept to understand. If you then look at the orange line here, I have just tried to highlight a different call option where the premium is now 2.5 instead of 5, but at the same time the strike price is increased from 50 to 60, meaning that this option will only start to hold value for you if the share price increases to more than 62.5. Another important concept to understand regarding options are, if you are buying an option, you cannot lose more than what you have paid for the option. So for instance, on the orange line here, you have paid 2.5 for the option, and if the stock price never increases to more than 62.5, well, then you will simply just not use your optionality, and you would have lost the value of which you have paid for the option, also referred to as the premium. If, however, the stock price increases to more than 62.5 and you choose to use your optionality, if the stock price, for instance, has increased to 70, then you would be exercising your option. The next concept, which is clearly illustrated here on this small drawing, is that you have to pay more for the optionality the lower the strike price of the option is. This is due to the fact that it is more likely that the stock will hit that particular value. It is more unlikely that the stock will increase and increase and increase and increase in value. Hence, you are paying more for having an optionality. This is referred to as the option is closer to being at the money. So this was just to give you a basic introduction to option theory. How does it look if we then continued with a covered call strategy? Well, a covered call simply means whoever is selling this call option already has the stock in their portfolio. So if, for instance, I were to sell a call option on my Merck stocks, then it would be a covered call since I already have the stock in my portfolio. So how does this work to increase my cash flow? Well, as we have just seen here, when you are buying an option, you are paying a premium. So that means if I'm the one who is selling this call option, then I will collect the premium. And that will of course increase my cash flow today. So at first glance, this of course looks very attractive because, well, you will get money in your pocket today. But what have you actually sold here? Well, you get money today, but at the same time, you have put a ceiling to how much you can actually gain in the future, because if the stock price increases dramatically, that means that you will have to hand over your stocks and you are only left with the premium. So effectively, you have lowered the cost of your stocks, but at the same time, you have put a ceiling to how much you can actually gain in case the stock increase a lot in value. There is of course one very important thing which I haven't mentioned yet, and that is when you are selling these options, well, since you are not providing the platform to do so, then you will of course have to pay a fee to your broker. So that will again lower the cash that you will get at hand today. So what potentially looked like a very tempting strategy, since you would get cash at hand today, and that is naturally very tempting if you are investing for cash flows like dividends. Well, the more you think about this strategy, the more you will realize, well, I have put a floor under my losses since I'm now receiving this premium, but effectively I have also slapped a ceiling on my potential gains. So let me remind you about Benjamin Graham's wise words from The Intelligent Investor. As an individual investor, it is never worth covering your downsides by surrendering most of your upsides. So that actually sums it up for yet another exciting week of the Lazy Money Game. So now you have seen what a covered call strategy is and why I am not particularly interested in pursuing such a strategy. So if you like content like this, then please consider leaving a like, leaving a comment, or subscribing to the channel. It really helps me out a lot. And until I see you next Sunday, bye!